All right. Welcome to the Ultra High Net Worth Clients Podcast. I'm your host, Chris Broadhead. We started this podcast as a way to create a central resource of the best financial advisor practice growing tips shared by the most outstanding advisors in the industry, of which our guest today is definitely one. These outstanding financial advisors agree to be on the show and provide a ton of value for free, all in the hopes that our audience might learn from their words. My father was a financial advisor, and financial advisors are the main clients we serve. So my marketing agency's mission is to help every financial advisor grow their business in an effort to help the world become more financially secure. Today, we have the rare pleasure of talking with an incredible financial advisor, Larry Kim. Larry, can you please introduce yourself and tell us a little bit about you?
Sure. Thanks, Chris. I work for Simplify Asset Management. We are a relatively new asset manager. We manage about 34 exchange-traded funds at the moment across a variety of disciplines. And I came to Simplify after having spent 20 plus years with Fidelity Investments in a variety of roles.
Mm-hmm. Awesome. So, yeah, a lot to unpack there. I like to start at the beginning. So, how did you find yourself in this wild and wonderful industry?
Well, Chris, there was no master plan. Um, I was a liberal arts major, and in
Hey, me too.
college, like like many of my friends, found myself without a huge direction. So I just signed up. I just went to my career office in college and signed up for whatever companies came on campus to give interviews. And remarkably, I found myself being hired by JP Morgan right out of college in a training program. So that's how I got started.
Okay. And did you find yourself enjoying the work, enjoying the industry, just kind of effortlessly succeeding? How? Tell me about that.
Um, I enjoyed it right away.
Yeah.
Not 100% of it, but for the most part, just the concept that you could work in an industry where an individual could actually grow, make money from those assets rather than from their own labor, uh,
Mhm.
was an extremely mind-blowing concept to me as a 22-year-old. Um,
Yeah. Yeah. The money does the work for you.
yes, exactly.
Yeah. That's awesome. So, you're working for JP Morgan. What kind of work do they have you doing?
Well, this program no longer exists, but it was a training program designed specifically for liberal arts majors. So they sent us to New York University Business School at night to get our MBA, because none of us knew a debit from a credit. So we started from square one. And I guess it was one of their early attempts at DEI of the day, right?
Mhm.
Diversity of thought that they thought that they would bring in by bringing in a class of liberal arts graduates.
Mm-hmm. Yeah, someone with a much different perspective than perhaps the traditional finance major.
Yes, yes.
Yeah.
And, I still keep up with some of my classmates from that program. And, a couple of them have moved on to different industries. One of my better friends ended up leaving and going to medical school. But for the most part, the majority of the people in the program stuck with financial services, which I find pretty interesting.
Wow. Okay. So they did a good job of showing you the glory of
Yes.
financial services. That's great. So how long were you with them, with JP
I
Morgan?
was then for a few years, and while I completed my MBA, and then I made my move to Fidelity Investments up in Boston a few years later.
Hmm. What inspired the move to Fidelity?
Well, number one, I had my accounts there, right? So I was a client. Um, Number two, it was just kind of a lifestyle choice. I had lots of friends up in Boston where Fidelity is, and well, that's where I wanted to be.
Yeah, awesome. And were you doing similar work at Fidelity as you were at JP Morgan, or was it a different role?
It was different at Fidelity. My focus was on product development and
Hmm.
product management. So, Fidelity has hundreds of mutual funds right now, and now a growing suite of ETFs. Uh, but when I joined, there were no ETFs.
Yeah.
So I probably was involved in the launch of 20 to 30 of their mutual funds.
Hmm. Okay. Got it. You're talking JP Morgan now?
No, this is Fidelity.
Fidelity. Got it. Okay, awesome. So what did you learn at Fidelity and JP Morgan that, you know, helped you achieve the success that you're, currently enjoying at Simplify?
Well, the first thing that working at Fidelity was like earning a second MBA, right?
Yeah.
Because a lot of my work around product development um, was working with the portfolio managers, understanding their investment process. How do we turn that investment process into an understandable theme or story that the Fidelity sales force could understand, that our
Mm,
Fidelity clients could understand, financial advisors could understand, and just continually working with those managers to market their funds and also to improve the funds and launch new products. So that was really where my true training was at Fidelity.
hmm. Okay, awesome. So you were you were helping to design all these products and then make them much more communi communicable to from advisors to clients and prospects.
Right. Well, the portfolio manager was really the key designer of the product, but we certainly came to them with, okay, well, what does the product lineup need, right?
Hmm. Hmm.
Or for example, are they starting to expand their sector fund lineup? They have a general healthcare fund, but do they have a biotechnology fund? Do they have a medical device fund? Where would that
Hmm.
fit in? Uh,
Hmm.
how would we approach the Salesforce and the financial advisor community with these products? You know, how would they use them in their portfolios and that sort of
Hmm.
thing?
Hmm. So was there a specific process to figure out like what products were missing or would benefit the advisor to add?
Well, ideas could come from anywhere, right?
Hmm.
Um, Very often, the ideas would come from the portfolio managers themselves. Um, in the research arm of Fidelity, we call that Fidelity Management and Research. Sometimes the ideas could bubble up from the client facing community who
Mm.
could say, hey, you know what? We really need this type of product or that type of product.
Hmm.
Or
Okay.
sometimes it could come just from people in marketing who just perceived a market need.
Yeah. Right. Right. Okay. Cool. And then, um, how would you go about working with the team to develop this product?
Well, it's I don't want to bore you with the plumbing, but
Yeah.
first of all, is the product even possible? Would it meet compliance and regulatory requirements? Right?
Hmm.
Does the management and research team, have the research to be able to run the product? Number two is, does it have a comprehensible story or theme that the internal organization could get behind? So it was just um, kind of like herding cats, all these different parts of the organization to make sure we could end up with a product that could be supported.
Hmm. Awesome. Can you talk about, a product you were particularly proud of and excited to work on or bring to market during your time with JP Morgan and Fidelity?
Um, I would say probably um, build number. Two things. Number one, filling out and building our sector fund lineup because sector funds were still, relatively new products at
Hmm.
that time.
What year was this?
This was early 90s.
Okay, wow. All right. Yeah.
Um, and also a lot of work around pricing. Um, you know, this seems kind of almost unbelievable today, but back in those days, most mutual funds had a sales load, even even for individuals that were not working with financial advisors. They were working directly with Fidelity. Um, so um, I worked on a lot of the analytical work to try to convince senior management to drop those front end sales loads for funds sold directly to investors.
Hmm. Hmm. And I'm actually not familiar with that term. What does front end sales loads mean?
Well, if you want to buy X mutual fund, you have to pay a 3% sales charge.
Ah, right, right.
That is still the way many mutual funds are sold today. That souls that mutual funds that are offered through financial advisors.
Hmm.
So I would say most financial advisors that you meet today have transitioned to a fee-based model, right? Fiduciary
Right, right,
model.
right. Yep.
But back in the 90s, that was almost unheard of. Pretty much all financial advisors worked off selling products with front end sales loads.
Hmm. Got it. Got it. So the ETF was a revolution in those terms. Um, can you talk about, the kind of development of ETFs and how that impacted your work?
Sure. Well, the first ETFs, were uh, early 90s. And I think the first one might have been SPY, which
Hmm.
is one of the biggest funds today. It's a fund that we're all aware of. Um, Now, back in the 90s,
Great.
there wasn't much use for ETFs because, as I said, uh, most financial advisors worked off of front end sales charges,
Hmm.
commissions.
Hmm.
And there's no commission to be had with an ETF, right? So, one of the things that really grew, I would say hand in hand, is the growth in ETFs along with the growth of advisors switching to a fee-based fiduciary model. Those two things kind of happened together in the early 2000s. Um, and so we evolved to a point today where advisors that still work for front end sales commissions is becoming increasingly rare. But the two things went hand in hand.
Hmm. You're saying the fiduciary model and ETFs?
Yes, because if you're a fiduciary, you don't need to rely on having a relationship with a fund family that would pay you a 5% front end sales charge, right?
Hmm.
Now you are free to design a portfolio as you see fit, right?
Hmm.
So, and you didn't have to all stick with one fund family. That was also very common in the day because if you were a financial advisor and you had a client and they had X number of dollars all with mutual funds in the same fund family, then they would qualify for the next tier of assets, which got them a lower sales charge, right?
Hmm. Hmm.
So um, you ended up with many clients of financial advisors having portfolios predominantly built with one or two fund families so
Hmm.
that they could take advantage of the pricing power to get lower sales charges.
Hmm.
With the advent of ETFs, all of a sudden that became irrelevant, right? Because there was no front end sales charge. The advisor would would earn their revenue by charging the client fees, and that fee would not change depending on whether they invested in a Vanguard ETF or a BlackRock ETF or a Fidelity ETF.
Hmm.
So that opened up a whole new world of possibilities for financial advisors who can now just scour the entire marketplace for funds that they deemed were the best fit for the client portfolios.
Mhm. Yeah, sounds like an improvement. Major
Yes,
upgrade all around.
there are, it is hard to think of any true advantages to the mutual fund model for
Hmm.
from the share owner's perspective. Um, I suppose that the one advantage, well, first of all, in workplace retirement plans like 401k, they're pretty much restricted to mutual funds
Hmm.
for compliance reasons and operational reasons, right? Because the employees can make a change and it'll be as of 4 p.m. that day, right? When the mutual fund calculates its NAV. It would be very difficult to do using ETFs. But for most individuals, there's really no reason to own a mutual fund anymore.
Hmm. Yeah, that makes sense. Are mutual funds even? I mean, are they just a shadow of their former self? Like, are there even movements in mutual
Well,
funds?
as an industry, mutual funds have been in net redemptions for more than a decade.
Hmm.
That means the assets in mutual funds have been going down. The flows. I mean, assets can still go up because the market has gone up, right?
Hmm. Right.
And also, they're still the predominant vehicle for 401k plans. So 401k plan assets have gone up. But in terms of just sheer flows, inflows and outflows, mutual funds have been in redemption for many years now,
Hmm.
almost completely taken over by ETFs.
Yeah. Do you think there's kind of an end date for mutual funds on the horizon where go extinct?
Um, it's hard to say if they would ever go extinct, um, especially until someone really solves the issue of how to make exchange traded funds work inside a retirement plan.
Hmm.
So mutual funds will probably have a place for the foreseeable future.
Hmm. Got it. Got it.
But outside of workplace retirement plans, um, there's really not much future for uh, mutual funds any longer.
Hmm. Why are workplace retirement plans focused on mutual funds?
Um, well, they're just much simpler, right?
Hmm.
And they're very operationally simple because if you say, okay, I want to switch from the growth fund to an emerging markets fund, okay,
Hmm.
you go online and you elect to make that switch. And then at 4 p.m., when the mutual funds all calculate their net asset values, that transaction exchange happens. Net asset value of one fund to net asset value in another fund.
Hmm.
If imagine, if you will, um, you tried to do this with an ETF. Now the investor would have to be a lot more sophisticated. You know, how am I going to do this? Right? I have to go online and I have to trade. The price is moving continually all day long from 9:30 a.m. to 4 p.m. Right? How is it going to work in dollar amounts? Is the platform going to allow fractional shares or dollar-based shares? Right? What ETFs are the clients going to be allowed to buy? Are they going to be able to buy the entire list of 10,000 available ETFs? You know, what happens if the if the employee blows themselves up? You
Hmm.
know, what if they buy a triple levered inverse uh, ETF that invests in, corn futures? I mean, so there are all sorts of constraints that just make mutual funds much simpler to use in a 401k plan.
Hmm. Okay. Got it. Got it. Yeah. Thank you for that. That was very clear. So, you are living and breathing these exciting, new products, ETFs. Um, what is the future of ETFs, and what is, mutual funds to ETFs? What is ETFs to the next potential product?
Well, ETFs is probably the most perfectly designed vehicle for investing that has yet to be made. Um, as far as what I have heard for what could be next, the only other type of product that I've heard of that has gained any traction at all is custom based indexing, where um, the the client would own the actual 500 stocks in the S&P 500,
Hmm.
but they went to their financial advisor and said, you know what, I'm an Apple employee. I've got $2 million worth of Apple stock. I don't want any Apple in my account because I'm already exposed there. So the
Hmm.
financial advisor can hook them up with a custom, you know, separate account index provider that would buy um, the 500 stocks minus Apple, right? So,
Okay.
so that's
Wow.
one use case.
Well,
Or
that's
they could
cool.
say,
Yeah.
uh, if the client has a big capital gains tax bill this year, they could own the basket of individual securities and then try to find those stocks in the account that have unrealized losses, and then take those sell those securities to generate realized losses to offset realized gains. So to be able to kind of tax manage an account. But really, this is a product with an extremely limited use for a very specific audience. Most ETFs, many ETFs are very tax efficient by their very nature. So that'll never be like a mass market type of product. So
Hmm.
the future really is ETFs for the foreseeable future,
Hmm. Just
unless
that.
there's another product that you could possibly think of is something happening on the blockchain, right?
Okay.
If you could have a tokenized product that would own, for example, the Magnificent Seven stocks, right? Traded over a blockchain, could that be a future vehicle? I don't know. I suppose
Hmm.
it's possible.
And what advantages would the blockchain based vehicle have over our current ETFs?
Well, the one thing I can think of is um, ETFs trade 9:30 to 4 p.m. Monday through Friday, not
Okay.
weekends or holidays or evenings.
Hmm.
Um, the blockchain can trade 24 by 7 by 365.
Hmm.
Um, so right now, settlement for exchange traded funds, it used to be T plus two, right? You settle in 2 days. Then there was recently a switch in the past year where the industry went to T plus one,
Hmm.
so that the transaction settles in one day. Settlement on a blockchain transaction is almost instantaneous,
Hmm.
right?
Yeah.
You make a transaction, a few seconds later, that asset is owned by you,
Yeah.
right?
Right. Right.
Um, and also potentially, and this is not good for the financial services industry, but it could be done without an intermediary as well.
Hmm. Directly. Yeah.
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 So, but I think we're many years away from any such thing happening. So for right now, ETFs are it.
Yeah. Wow. Um, so what is your feeling on how the blockchain and crypto will affect kind of future products and future behaviors? Do you think it's, I mean, going to become much more mainstream and
Well,
adopted?
it's
And
it's already mainstream. I mean,
yeah.
the Bitcoin spot ETFs are the fastest growing uh, asset category in the ETF industry's history.
Oh wow.
So I don't even I haven't even looked recently about how much assets the iShares, the BlackRock, Bitcoin ETF has, or the Fidelity Bitcoin ETF, but we're talking of hundreds of billions of dollars. So in a very short amount of time. So now that there's the Ethereum ETF, so yeah, it if new tokens can gain traction, there'll probably be an ETF behind it some point in the future. Now they've got leveraged Bitcoin ETFs. Simplify, my company, we actually have two products that invest in Bitcoin in some way. So it's already affecting many different ETF providers.
Got it. Yeah, tell me more about Simplify. What inspired you to go to Simplify?
Simplify was started in 2020.
Mm-hmm.
And like many of us, if you can remember the lockdowns in the spring of 2020.
Oh, remember them well.
So I'm working out, exercising in my own basement in my house. And while I do that, I frequently listen to financial podcasts.
Yes.
And I heard a podcast in which Simplify's founder and CEO, Paul Kim, no relation, was being interviewed. And I remember stopping my workout and I just sat there and I listened to the entire interview, beginning to end.
Mm-hmm.
And then I sat there and I listened to it again.
Whoa.
So I'm sitting there in my workout area and I listened to the interview twice. And I was just so fascinated by what he had to say that I went to the Simplify website, found an email address and sent in my resume. So I was employee number 7 here at Simplify, and I started at the beginning of 2021.
Wow.
Yeah.
That's awesome. So what was it about what he said that so inspired you? You had to listen, you had to stop your workout, listen twice, and then submit your resume.
Well, for the most part, with a few exceptions, most ETFs, the vast majority of ETFs, are pretty much replicas of what you used to see in the mutual fund world, which is stocks and bonds, right? At Fidelity, there were only 2 asset classes, stocks and bonds. Right? Now, there were some ETFs. So, for example, GLD, right, which is the gold ETF that's been around for a while, right? There have been some commodity ETFs and even a few ETFs that had exposure to derivatives. But derivatives in particular were very difficult to use in an ETF, right? The rules were unclear. They required, lots of exemptions, regulatory exemptions to get through. And was it late 1999, SEC Rule 18F4 came about, known as the derivatives rule, which made all of a sudden derivatives much easier to place inside an ETF, right? Because the rules were just clearly laid out for the first time, right? So that opened up the gates for derivatives-based products, which is how we got our start. So we have products. Well, our lineup is pretty complete now. So we have strategies that are pure equity funds, actively managed, smart beta, but we also include strategies that will include derivatives as a risk hedge. So to protect against the downside, or adding derivatives to enhance the upside, or using derivatives for capital efficiency purposes, otherwise known as leverage. So I can give you an example since you asked about Bitcoin or crypto. We have one product that I believe is the only one of its kind. It's 100% stocks, large cap US stocks, just in an index based, plus 10% in Bitcoin.
Mm-hmm.
And it automatically rebalances. So one of the things about Bitcoin that's kind of difficult, I don't know if you own it personally, but it's pretty hard for most people to rebalance. And the reason is because its trends get so extreme that when it goes down 80%, you think it's going to zero, right? And you never want to
Mm-hmm.
buy it anymore. And when it goes up 500%, you think it's going to the moon, right? So you never want to sell any, right?
Mm-hmm. Yep.
So having a mechanism that will automatically rebalance, buy more Bitcoin when the price is low and sell some when the price gets high,
Yeah.
that's an extremely psychological advantage for the investor. But the other thing I wanted to mention, it's not 90% stocks, 10% Bitcoin. It's 100% stocks plus 10% Bitcoin.
I see.
So
110%.
110%, so which obviously means there's a little bit of leverage involved, right?
Mm-hmm.
And we can now easily get that leverage using a combination of cash equities plus some futures, S&P
Mm-hmm.
500 futures.
Mm.
So that's an example of some of the creative things that you can do using derivatives, which just became much easier beginning in 2020. And
Mm-hmm.
that was just the genesis of how Simplify got started.
Mm-hmm. Awesome. And advisors and investors can benefit from Simplify by buying some of their ETF products.
Yes, that's that's it. I mean, we've got 30
Yeah.
plus ETFs in a variety of investment categories. Um, I'll give you another good example of capital efficiency.
Mm-hmm.
So we just launched a fund using options that's based off of the 10-year treasury, right? The 10-year treasury has a duration of about eight years. Um, and this product has a duration, close to 40, and it's based on the 10-year treasury.
Oh, wow.
So you know how you build a 60-40 portfolio, 60% stocks, 40% bonds? You can get the equivalent bond portfolio exposure by putting 5 or 6% into this interest rate product.
Mm-hmm.
Now it's extremely volatile, but you only need to own a small amount. So if you've got 60% in stocks and then you put it 6% in a product like that, you've essentially have a 60-40 portfolio.
Mm-hmm.
But what you also have is 34% that's left over, right? And
Mm-hmm.
you could use that 34% to invest in anything else that you wanted.
Mm-hmm.
Ideally, it would be a diversifying asset that had low correlations with stocks and bonds, right?
Mm-hmm.
So maybe that would be something like commodities or managed futures, or you could double down and just invest in whatever else you wanted, crypto or, real estate or more bonds or whatever area of the market that you favor.
Mm-hmm. Awesome. Awesome. That's really cool. Um, Larry, we are coming towards the end of our time together. You were a super knowledgeable and fascinating fellow working on some really cool stuff. So, I've super enjoyed hearing from you and learning everything I can from you. My final question for you is an open-ended question. You can take it in any direction that you like, and that question is, what are you working towards?
We are working towards building a suite of products that the average financial advisor can use that were previously only available to sophisticated institutions.
Mm.
Um, we're talking products that were basically unobtainium, right? Um, so that's what we're working on.
Mm.
And, I hate the term democratized finance because it's an overused term, but that's
Yeah.
essentially the mission of what Simplify is all about.
That's awesome. And it sounds like you and the team are super passionately working on solving this problem, and the investment industry, we'll have a lot to thank you for now and into the future. So, thank you again for coming on the show. You're a fascinating fellow and incredibly bright, and um, you know, way to go, JP Morgan, for bringing you in, convincing you this was the path you wanted to be on. Where can my audience find out more about you and everything you and Simplify are working on?
Uh, just go to our website, which is simplify.us. You can also find us on our YouTube channel. Just look for Simplify Asset Management. And we have explainer videos on there that show how all our products work.
Mm-hmm. Awesome. We'll link to all that in the show notes. Yeah, Larry, thank you again for coming on the show. Everyone who tuned in, thank you so much for hanging out with us today, and keep on growing out there, everybody. See ya.